In my opinion, I think the time for a decent rate of return on 30-day T-bills or money markets, I think the time has passed. The rate is no longer super compelling after taxes. And I think it's really hard to say that we're going to see the entire yield curve move down meaningfully over the next 2 years, but that could happen. That is sort of the current administration of the Treasury Secretary's goal, is for lower rates to help basically finance our government's operations and deficit. And I think it's an important conversation to protect yourself against that if you are a fixed income investor, especially if you're a fixed income investor who's been really leaning on the short end of the curve. If you haven't locked in a portion of your portfolio longer term, I think you really need to consider doing that, because the rates are still compelling, especially if you're looking at munis, municipal bonds. 15, 20, 25-year municipal bonds, you can get a meaningful rate of return comparable with what you were getting on the short end of the curve just a year ago, which maybe doesn't sound like a great deal, but it is, because you're locking in 15, 20, 25 years worth of a pretty compelling interest rate, especially if you're with municipal bonds, they're tax exempt. So I think we're at a really important inflection point for fixed income investors.